Okay, so we were looking at a set of criteria. So we'll continue looking at the criteria. And after that, we also have to do one more important thing, which is to look at the returns and calculate means based on the stock's returns and expected earnings. Sorry, based on the stock's PE and expected earnings, we need to see what are the kind of returns that we can get. And we will use that math to just complement our earlier approach as to why we need to buy stocks with the low PE. So first thing is the company issuing new shares? Is the equity getting diluted? So if the company is issuing new shares or if the equity is getting diluted, then the percentage of, so let's say I own, uh, uh, or is the company buying back shares? So if the company is buying back shares, it means the total number of shares reduce and therefore the ownership stake basically increases. So earlier, let's say there were 1,000 shares and let's say there were 100,000 shares and company buys back 10,000 shares. It means the remaining number of shares are 90,000. And therefore the remaining, let's say dividend distribution, etc. If earlier it was for 100,000 shares and now it is for 90,000 shares. Similarly, if the company is diluting its equity stake, just adding more and more shares so that it can raise money, that is something we need to be very cautious about. So this is, I mean, typically not one of the most important criteria that I have. I generally don't even check it, but it's just something that may be a red flag if we see that if it's suddenly getting too diluted, or it's a green flag if you see, oh, company is doing a share buyback. Then is it an end consuming product that I can test and form an opinion about? So one of the things in terms of identifying good companies is if we actually use their products and see their products, we get a first-hand knowledge in terms of how good or bad the product is. So this is one good way in which we can figure out whether this company is actually making good products. So day-to-day things like clothes or footwear or other things, jewelry or other things, we can just use the products of the company and then we can form an opinion about. So if we find some product that we really like, then maybe we can see, hey, is this company actually available in the stock market? Okay. The next thing is, what does the management say it will do? So the management says, hey, we will grow by, say, we expect our profitability to grow by 20% per year for the next 3 years, right? They may say that. And then 3 years later, has the profitability actually grown? Does the management keep its word? This is, if the management does not keep its word, then that is something we need to also be a little cautious about. But of course, this is a little difficult to check these days. But we can use use notebook, LLM, etc., and just find it out. Before we had these AI tools, it was always a little difficult to check in terms of what the management said it will do. Has it been keeping its promises? If a management does not keep its promises, has not kept its promises in the past, then that's a management that you cannot trust. It may not keep its promises in the future also. Then is this company in an area where promoters need significant amount of political connectivity? Uh, Now, typically, we should avoid those kind of areas where a lot of political connectivity is needed. Uh, One is that if, let's say, the ruling government changes, right, and the new rulers have the new government has a different idea in terms of what needs to be done, or whether that industry should receive importance or not. Or maybe the new government is connected to some other people who are a competitor to this company, right? So these kind of things are very dangerous for our stock, and therefore typically it is better to focus on those types of companies which are dependent on end consumers or other businesses, etc., and not does not have too much of political connectivity involved. And then what is the company's moat? So company's moat is, what is it that differentiates uh, what is it that differentiates a given company as compared to its competitors? So that is also something that we need to look at, right? So there can be things such as brands, there can be patents, there can be low cost. So a particular company may have a certain process, uh, a patented process of producing goods, which involves, which helps it produce the same goods at a lower cost than competitors, right? High switching costs is another type of moat. So then, for example, what is high switching cost? Let's say that an organization has employed an ERP and they have used, for example, SAP. Now, that SAP project itself for implementing that ERP system, that itself might take maybe several months, right? And now, if the company wants to switch from, say, SAP to some other ERP, maybe Oracle or something like that, then that involves a tremendous amount of cost. The company will not be doing that. Once a company is into, say, an ERP like SAP, then that company is likely to continue using SAP for several years, decades to come. So in this way, we should see, okay, what is it that is special about the company? Why will the customers keep using that product? Why will the customers keep paying for that product? And then typically, so this is not a strict guideline, but relative retail public, if the retail public holding is less, and if the FIIs and DIIs are holding is very high, it means that strong hands, the learned people are people who have a lot of scope to do in-depth research, etc., have a generally strong opinion of the company, and that should increase our confidence. So I will not peg this number at 30% or 40% or whatever. But generally, we should go for those companies where the FII and DII holding is higher, because then we know that, okay, multiple people have done in-depth research on the company. They have met the CEOs, they have met the top management, they have gone to all the companies, offices, factories, warehouses, etc. And then they actually think that the company has a great future for whatever reasons. So with this, I think we come to the end of some of the guidelines that we had discussed. Now, again, we will rarely find organizations that satisfy all the guidelines, but these are just things that we can use to find out any hidden dangers or use to understand what are the kind of risks the company may have. Right. So this is one. And the next thing that we have to do today is stock valuation. So how do we basically figure out what is the kind of stock growth? Right. So let's take this sheet over here. Okay. And now let's see what we are seeing over here. We are now seeing, let's take any organization. Let's take, for example, Britannia Industries. Now we find that its profit is 2,134 crores. Okay. So let's say it is 2,134 crores. And we want to decide whether it's a good time to buy the stock, or if we buy the stock, what kind of returns can we expect? We go to the sales, where we see that, listen, its profit growth is only some 19%, 13%, 5%, and minus 4%. So let's take a scenario where Britannia doesn't grow much. Let's say it just grows at 5% over a longer period of time. Okay. Now we have to calculate what are the estimated profit growth, right? So this is nothing but this into 1 plus, okay. And then we do this and then we find that at the end of 10 years, Britannia will have a profit of about 3,476 crores. Now, what is the PE of Britannia? So let's take a conservative scenario. Let's look at the price to earnings of Britannia. And we find that this is around 55 on average for the last 5 years. Let's take 10 years and we are again finding the average is around 55, right? So let's say that end case, it is only 45. Okay. So profit into this. This is the expected market cap of Britannia in 10 years. And the current market cap is only so much, 122,880. Okay. So assuming that we buy Britannia now, and assuming that at the end of the 10 years, this is a conservative scenario that we are starting with. Assuming that Britannia has grown only by 5% for the next 10 years, and because it is growing so slowly, the PE has gone down. Investors don't value the company as highly as they value it today. If that scenario happens, then we can expect the stock to stay stable and only grow to about 25% more, 27% more in the next 10 years, right? Now let's take another scenario. We saw that in the last 10 years, Britannia's profit growth was 5, 13, 19. So let's take a case of maybe it's growing at maybe 12%, for example, right? So I put this here. I replace this. And let's say because it is growing at around 12%, this number is about 55. Okay. So if this number is about 55, then the market cap at the end of all this, market cap is the earnings into the PE ratio will give the market cap, right? The price is nothing but when we consider it individually, then it is the price that we pay for each share, right? But here we have taken, but when we consider it for all the shares, it is nothing but the market cap. And then we see here, now this goes to some 3.64 lakh and now it is currently 1.22. And therefore, in the average case scenario, maybe we can expect a growth of around 3 times for Britannia. Now let us say that Britannia's profit is actually growing pretty fast, right? So it continues, it's able to revive the growth in profit. So let's put it at about 18%. Because the profit is growing consistently well, we'll assume that the PE ratio, investors are valuing the stock highly. So they give a 65 PE at the end of the, say, 10 years. Now this is not 22, this is actually 24. So we have to, we just have to change these dates. Okay. So then at the end of FY34, the Britannia's market cap will be 7.25 lakhs. It's currently so much. And in the best case scenario, Britannia might go up by about 6 times. So now we have an idea. Say if I buy Britannia today, what will happen in the next 10 years? You know, if it grows slowly, I'll get maybe 20, 30% return only in the next 10 years. If it grows reasonably well, I may get, say, about 2.53 times the returns. And if it grows fast, then I may get about 6 times the return. So we now have an idea saying, okay, what might happen in the stock in those different cases? And that is what was drawn here. You can see a bear case, you can see a moderate case, you can see a bull case, the aggressive case. And then we see here what is the kind of growth that we have seen in the market cap. We see the PE, then B13 into B15, which is nothing but the earnings into the PE, which will give the market cap. We see today's market cap. And then we see what is the kind of growth we have on in all the 3 different cases, in the conservative case, in the aggressive case, and in the moderate case. So this way, we can figure out, okay, is it a good time to buy the stock or is it not a good time to buy the stock, right? So one of the best times to buy the stock is when today's market cap is very, very low. And when is the market cap low? The market cap is always low when the price falls down, right? Market cap is nothing but number of shares into price per share. So number of shares typically will let's assume it remains constant. But as the price keeps varying, so when the price per share goes down, the market cap will go down, and therefore one of the best times to invest in the stock is during a bear market when the markets are terribly down. What is the second thing what is the second main factor that helps in the growth? If the company's profit continues to grow very fast, right, then we can expect that this profitability will go, this profit number will go up very high, very fast. It will be very high. And because this profit number is contributing to this market cap, therefore, this profit growth is very important. And the third calculation is what is the price to earnings at the end of the time period. Typically, what happens is that when a company shows fast growth, investors get a lot of confidence saying, oh, this company is growing fast, and then we will see a expansion in the PE. And once there is an expansion in the PE and then there is also a fast growth, then at the end of all this, the company market cap goes up very significantly. And that is when we get a multi-bagger. Multi-bagger is like, it gets 3 times, 5 times, 10 times return. So let's look at a few examples here. So KPIT is working on, say, software, for example, for electric automobiles and so on. And it has a global presence. So now let's look at this company for throughout its history, and let's look at the PE over here. So we can see over here the PE was about 7 during April 20 during COVID. And then over time, the PE has gone up, gone up, gone up, gone up, gone up, gone up. And then say both over here and somewhere over here, this PE, which was 7, has gone up to about 90. Right. So when the stock was, let's say a stock is, so just because of its PE expansion, right, KPIT price went up by 12 times. So if the PE was just the same thing, if the PE was 7.4 or something, whatever it was then, if it's the same thing today, the price will be much lesser than whatever it is today. And then what about earnings? You can see during that time period, we'll assume 5 years since we are looking from the start of COVID. So during that time, earnings also went up by 49%, right? So this average earning went up by 49%, but because the PE went up by so much more, the increase, the stock price growth rate is actually 68%. And this is how we get a multi-bagger. A company typically grows fast, and then the PE expansion is also there. As the company continues to grow fast, investors start gaining more and more and more confidence. And then the PE is also very high. The earnings have also grown significantly. And therefore, the price, the overall stock price becomes very high. So let's just try to calculate the 3 scenarios for KPIT: bull case, bear case, and say what will its price be over the next, say, 5 years. Okay. Let's remove all this. So we find in March 24, it is 599. Now we found that KPIT's growth is 49, 61, 49. This is what we find. 5 years, 3 years, and whatever, last 1 year, this is the profitability growth. Let's say there is some problem, company is not able to sustain it and it goes down to 25%. Okay. So these are the numbers we get. Today, the company's PE is around 50, price to earnings is around 50. Because the company's growth is slightly slower, let's say it goes to 45. So the market cap of KPIT will be around 1 lakh. Okay, at the end of the time period. The market cap of KPIT is 36266 today. So what is the bear case growth? The bear case growth is that in this time period, during this time period, right, KPIT share price would be around 2.8 to 3 times. Now let's take an average case. Let's say it grows at 45%. Because it's growing at 45%, let's say the PE is 65. And now we can see if KPIT continues to grow the way it is growing, and if the price to earning at the end of the time period is also fairly reasonably high, then this market cap of KPIT will be 3.61 lakh crore. And compared to what it is today, this is almost 10 times. That is what we get over here. Let's assume a very aggressive case where it's actually showing 50%. It's highly unlikely, but let's just say it shows this kind of a number. Or let's make it 55% since we gave 45 and 50 is not too different. Let's say it grows at 55%. And because it is growing so fast, investors love the stock. They have given it a PE of 80. And now you can see in this case, this market cap at the end of the time period is 6.64 lakh crore. Today it is 36,000 crore, and this is a growth of more than 15 times, almost 18 times. So depending on these cases, we can form an opinion in terms of when we should be buying a given stock. So the first thing is that the stock price, we don't know how high or how low KPIT stock price may go down. KPIT at its highest was 1,865. Now it is 1,300 something, right? So we don't know whether it will go down any further, whether it will not go down any further. But if we want to estimate what kind of returns we can get from today onwards, if I hold it for 3 years, 5 years, 10 years, 8 years and all, we can use this sort of a calculation and then get our scenarios, and then we can make a decision saying, okay, do I want to buy the stock or not? Now, one of the key factors, as you can see over here, is that companies that continue to grow fast will be giving a much higher returns. Companies that are growing slowly will overall give a much lower returns. And therefore, the market loves and prefers those companies which are typically growing very fast. Okay. So any questions on this calculation? Was it clear? Any doubts?
No, Harish. Only thing is for companies that are growing fast, like how it happens in normal life is for the initial years, like in the case of KPIT, if it is growing at a very high rate in the initial years, then maybe later on it will slightly slow down. So it is important to, at least if not in the first or the second year, we should be able to identify a multi-bagger by the third year, so that by the time its growth tapers off by say the 10th year, we have reaped in most of the profits. Or have you come across any company which has continued to be a multi-bagger over a period of say 10 years, 15 years, 20 years, except
See,
like Asian Paints?
Asian Paints and all have been multi-baggers over a longer period of time. But their growth is obviously getting slower as they have become bigger. So we can even model those kind of scenarios over here. As you can see, we can say that, okay, since KPIT is a smaller company, let's say it's growing at 45% for next 2 years and 30% after that for the next other 2 years, and then 25% as it is growing bigger, its growth is slowing down. And let's say because it is over here and by now it is a more established company, let's say the PE at the end of the time period is 65. And then we can find out what kind of a growth we can expect. So even these kind of scenarios can be modeled in this Excel sheet. But typically, the best thing that we can do in using such calculations is we have to find out companies which have low PE but fast growth, low price but fast growth, low PE but fast growth. That those are the kind of companies we should look at. And as per these calculations, those are the kind of companies that will give us multi-baggers. So we need to see, is it growing fast? Is it cheap? And then will it continue to grow fast? What kind of expansion can we expect in the market? What kind of influence will the maybe if there is a crash, for example, what will that do? Will the growth suddenly stop? If there's a market crash, if there's a crisis, etc., if there's a COVID, etc. So based on all these things, we have to estimate what might be the growth. Will the market grow? Will more users start using this type of product, or or is it a new technology that will get more adopted easily? So we have to estimate. We're looking at those factors. We can never estimate the exact growth, but we can put different scenarios here and see whether I should own the stock or not. And typically, once we get good numbers for almost all the scenarios, then it is time to just buy that stock during a correction, right? And then just hold it for the designated time period and see what happens. Typically, we'll end up making good money.
Yes.
So this was one of the main things, and now I think we'll start. I think from a fundamental analysis perspective, we are done. Now we'll slowly start with the technical aspects. So we are now looking at the same stock, KPIT Technologies. And we are seeing this for a period of maybe 1 year. Now we have expanded this KPIT stock, and now we are seeing this for a significantly longer period, from the year 2022 onwards until now, about 2.5-ish types. Now, how do we know if a stock is cheap or if a stock is costly? One way to look at it is we see we saw all the fundamentals. But another way to look at it is, this is something I always use. We use the moving averages, right? So over here, this black line represents the moving average of this moving average price of the stock over a period of 200 days. The red one is for 50 days. The green one is for 20 days and the blue one is for 8 days. So we see that as the stock is going up, going up, going up, we can see over here as the stock is going up, 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 the moving average basically tends to follow. All the moving averages tend to follow. We see that when the price is growing fast, especially when the price is at some level of its peak, this part, etc., we find that the black line is lower than the red line. 200-day is lower than 50-day. 50-day is lower than the 20-day, and 20-day is lower than the 8-day. So what does that mean? That means that this stock has basically jumped up very fast, right? So if you see this period here, or this period here, or maybe this period here, you can see that the red line, the blue line, and the green line here are somewhat at the same level only, while it is higher than this one, the black line. So here you can see the price is largely stable. It has not jumped up from November 23 to maybe Jan end 24, mid-November to Jan end. It has not jumped up, and therefore these lines have come like this. And then as this continues, as this stable price continues over here, you can see that this is actually crossing over. Now 50 is higher, 20 is lower, 8 is even lower. And then again, they are together. So we know here that there's not been much of a jump, right? Then again, the stock goes through a bit of a jump, and then the stock falls. Now, one thing we find as the stock falls is, here the 50 period was on the higher side, but now this has come down. The 20 period is lower, and then the 8 days even lower. So this is a good time when the stock seems that, okay, the stock has corrected by from 1900, or what was the highest price? Okay, from 1900 to about 1300. So it has corrected. And then this is actually coming down. So this indicates, so when we look at these lines, This is one more way of saying, okay, is the stock at a price where we can buy it or not? Whenever it is on this higher side, right? Whenever the 200-day moving average is less than 50, and they are maybe less than the smaller 8-day moving average, 20-day moving average, then we know that the price is high. We should not buy it then. But once this price has come down, then we can say, okay, now the stock is going to look interesting. So this is one of the simplest ways in which we can figure out whether a stock is looking has a good buy, has a good opportunity for being bought or not. Right. Now we see over here that there is also the price to sales, market cap to sales ratio. Right. And therefore, while comparing this, we can also see when this number is very low. So over here, this period, for example, you can see that the price to sale over here is 5.2, 5.28 during this time. We see it over here. You can see that this is 5.28, whereas during its peak, that same price to sales went to some 8 point something. Again, you can see here during this peak, the price to sale is about 10, 10.3 something. Now it has come to about 6.5-ish. So, right, the price to sale has also come down. So this means from a valuation perspective. So again, the reason I don't use PE is because of artificial earnings depression, or because the earnings suddenly go up. This number may the PE may not show a right picture. So I typically tend to use market cap to sales. And over here we can see from a valuation perspective, the stock has gone down. From an SMA perspective, also from a simple moving average perspective, we can see that okay. Now this stock has basically also the moving averages wise 200 days higher than 50, which is higher than 20, which is higher than 8, which means stock has been trending downwards, right? So this gives us a picture saying that, okay, this stock seems to be at a good zone where we can buy it. Now, what we need to see further is what is the financial performance of this stock. Now, again, when we are discussing any stock, it is only as an example. We have to do the research in detail. So when we see the financial performance of this stock, we can see that September, this is 1,200, this is 1,470, like 20%, more than 20% growth in sales. This is 141, this is 204, almost 50%, 45-50% growth in profit. And we see similar trends over here. The sales is growing, the profit is growing. The sales is growing, the profit is growing. So then that is an indication that, hey, the company's financial performance is stable, is looking good, but the price seems to have kind of come down. But again, we have to understand, why has the price come down? Is there some other news? Is there some news that is bad news? Like, for example, there is a war somewhere, and because of that, it's affecting the company's operations. Or maybe there was some fraud or some sort of a negative issue that was found. Or maybe, there is some change in technology, or that there has to be some reason why the price goes down. We have to understand all those aspects, and then we have to take a decision saying, okay, are those temporary factors? Do I think that, they will permanently affect the company's mode of operation, or is it something that is uh, just a passing phase, and whether the company will recover? So if we have confidence in the business's future, if the business has a low valuation, and typically when the business has a low valuation, the price will be low, then that is a good time to buy the business, to buy the shares of the business. Right. Now let's remove all the moving averages and let's look at the price. We had seen candlesticks chart earlier, so we will not be discussing all this again. But as we can see in this phase, we can see right now the stock is at a peak. There's a low, and then there's a lower high. So this high was higher than this high. And then the stock comes down, and then this high is lower than this high. And then the stock comes down, it rebounds. And then you see this high is lower than this high, lower, lower. So here the stock is trending downwards. And then over here, you can see in this low also typically the lows are getting lower. This low is lower, this low is lower, this low is lower, and so on. Now over here, you can see after this low, there is another low, but since these lows are growing lower, but this low is actually higher than this low. And you see here, high, lower high compared to this, lower high compared to this, lower high compared to this. And now we can see suddenly there is a higher high. So we can never be sure, but looking at this, so let's look at this point and let's also see this. Looking at this, we can say that, okay, now the stock's trend seems to be changing. Valuation wise, the stock has a very low valuation and it has been trending down. And so now here the stock seems to be trending, the change in the trend where it was going low, 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 low seems to be reversing. And now maybe it is headed for a bull run, right? We wait for some more time. We can see here again, there's a lower high, higher high, right? So again, there are bearish forces pulling in. But once it comes here, the stock is again going up. So again, there are bullish forces coming in. So you can see there is one low, similar low, and then there is a higher low. So somewhere here we can take a call, or max somewhere here we can take a call, right? Because now high, higher high, and then it's coming low, and then it's starting to go up. So we know this low is higher than this low. This low is higher than this low. So somewhere here we can take a confident call saying, hey, the stock is now turning bullish. The valuation anyway is already so low, and then this is another good point to buy. Right. So now we can see over here, when we see the latest one, we can see high, similar high, lower high, lower high, and then the stock absolutely goes down. After it goes down, now the high has come, and again we can see a much lower high. But then again, it goes down, and then you can see this low is slightly higher than this low. But after that, we see one high, and again, this high is higher than this high, lower high, higher high. So again, here we see that the stock is forming a bullish, bearish, it's still showing bearish trend going downward. But now when we come here, we see this low is basically higher than this low. So then we think, hey, maybe the stock is showing some bullish strength. And then when we come over here, we see now this high is higher than this high also. So maybe there is a fight going on between bulls and bears. There are people who are buying and then there are people who are selling. It is clearly not a downward trending stock. One more thing, if we see over here, you see this and this. We'll draw one more line. So we see this low is somewhat similar to this low, which is somewhat similar to this low. And now we have a low slightly lower. And then we have another low that is somewhat in this range, right? If we go back, no. So we can see 1 time, 2 time, 3 time, 4 time, 5 times, 6 times, around 6 times in this range of say 1288 to 1322, say around 1300 plus or minus 10 rupees or plus or minus 20 rupees. In this range, the stock has typically been forming lows, lows, lows. So this stock seems to be forming a resistance around a support around this point, right? So we are seeing that, okay, the bull trend seems to maybe, the bearish trend maybe seems to have ended. We see that there is some power of the bulls. And so here there is some sort of a support zone. The valuation is low. We looked at the simple moving averages and we see that simple moving averages wise, it shows that the stock is at a low price. So maybe this is a point where we could seriously consider purchasing it. We've seen the financial performance, it is good. We have to do further research on the stock and we have to be convinced that, we think that the stock has a lot of positive things and it's going to come up. If we think along those lines, and if we look at these charts, then all of those indicate that perhaps, this stock can be a good purchase. But again, that decision has to come basis our understanding and the analysis of the stock. So we have to look at, say, we see in the financial results, we have to look at all the commentary in terms of what the con calls are, what is being spoken, and all of that. And then see, are there any reasons that the stock may go down further? Is there some prediction they have given that no, we expect a very difficult, say, next 1 year or something? If they have said that, then maybe the stock may go down further. But if we find only positive or generally positive things, nothing so bad in terms of the overall outlook and in terms of what the management is saying and how the overall market is, then this is a good time to consider buying the stock. So typically over here, we are looking at three things actually in this chart. Right. First thing we are looking at is the moving averages to indicate where the moving averages are very high and where the moving averages are very low, and where the prices are very high, where the prices are very low as a result of these moving averages. Second thing we are looking at is in terms of the price to sales ratio. We are looking at valuation. Is the valuation on the higher side or is the valuation on the lower side? And then third and final thing that we are looking at is we are looking at the market trend to see what are the other, buyers and sellers in the market doing. Who is right now having more power? Is it the bulls, the people who want to, or the bears, the people who are selling or the people who are buying? And then we look at all these factors and then we do a fundamental analysis and then we take a decision saying, do I want to buy the stock or not? Okay. So any questions on this one?
Yeah, like if you go by the theory of efficient market, so whenever there's a price increase or a price decrease of a stock, then it means that there is some information which has come to the market. So, like for example, in the case of Vijay Diagnostics, I think of 10 or 15 days back, they had their quarterly report, and at that time, their I think CFO has quit, the chief financial officer, and after that, the stock has been falling down continuously. But if you go to Google News and you search, then except I find only one or two pieces of news which says that the CFO has quit, and that is the reason why stock price has been tumbling down. But apart from that, there are not many news. So, which is the best source for getting like up to date news? Because these traders, these brokers, the big players, they also must be relying on some news. So,
They
which
don't
is the
rely
best
on
place?
news. They don't necessarily rely on news. They generate the news often silently
Okay, so what you mean to say
to
is like,
manipulate the
yeah,
behavior of the smaller players.
the retail players, so that if they want to make profit, then they'll generate negative news and bring the stock prices down, and then vice versa.
If they want to
Buy,
buy, if they want to buy, they want to bring the stock prices down, they'll generate negative news. And if they want to sell and they want to push the stock prices up, they'll generate positive news. So a lot of that happens behind the scenes. So that's why we need to be very discerning and careful about what news we take into account. And a lot of times what happens is before, and if there is any genuine news, right? A lot of time what happens is you will notice that the stock price may already start showing movement before the news has come
okay.
out. So, before a company wins a big deal, some big contract and all, the stock price starts already showing some upward movement. And then the news will come out a few days later. So the only explanation for that is some people in the market may be actually aware of that these things are going on and that's why they are buying it. And then the news comes out, right? So rather than rely too much on the news, what we should do is I rely more on these things because this gives you the behavior of the market participants. What are the other people in the market thinking? So if you look at this, say before this stock came down, you see this high, this high, this high, this high. Already we are seeing a slightly downward trending line here, right? Slightly downward trending. So already we can see here that, hey, the market participants think that the stock is very highly priced. Right? There is more of selling activity and then the price goes down. So rather than rely too much on the news, primarily we should rely on the factors that has been given here because news, if we rely on the news, we may ourselves get manipulated by those players who want to generate fear and generate greed so as to achieve their goals.
And then one more doubt, like, why do they like see if with my preliminary knowledge, I can make out that a company like KPIT or some other established company like say Bajaj Finance is set for growth for say next 5 years or 6 years. Then I think that knowledge is also known to these brokers and these other big players, then why do they not remain invested in these stocks and wait for like 3 or 4 years and reap in the returns rather than uh, buy and sell? I mean, do this so frequently, so that, I mean, it just doesn't make sense. Or is it because it is a deliberate ploy so that when the prices come down, they'll buy, and then when the prices go up, they'll sell?
So a lot of big players will be buying in the dips. There'll be a lot of big players who would have accumulated here, would have accumulated here, accumulated here, accumulated here. So you can see, right? If you just look at this, you can see over here that there seems to be a fairly horizontal line. Price is not going below this. Why? Because the minute price is coming around this range, then there are buyers, there are powerful buyers. That's right. There are powerful buyers who are buying so much, a huge amount of stock and not allowing the price to go down further. And therefore, these big players and some of these smart, strong hands it's very likely they are accumulating the stock. And then once it goes up, they'll be getting rid of it. So for example, in KPIT, let's ignore this for a minute and let's go to KPIT again. Now we see over here during this phase that the stock is at this range from July all the way till October, right?
Yeah.
During all this period, the big players who have, very huge chunks of the stock, they may actually be getting rid of it. And then the stock crashes.
Okay.
So they may not be able to do that in, say, one trading session or one day or something. They'll do it over a period of time.
Okay.
So we should rely more on these charts. News, I mean, it's good to read and good to know, but we should always be cautious not to get manipulated.
Because for Vijay Diagnostics, what I saw is that the stock prices are tumbling for last 10 or 15 days maybe. But at the same time, if you go to the share of the uh, people who are, you see that the FIIs and the not FIIs, I'm not sure, but the DIIs and the mutual funds, they are increasing their stakes, they're buying. So when the entire market is selling, why are they buying? That was something which was
See, I have
confusing.
not seen the stock of Vijaya Diagnostics, but I think we had discussed that this stock looks ripe to be, maybe to be sold, because you see the charts here. You see this valuation here, price to sales is 8. But over here, price to sale is some 20. Here,
Yeah.
this is like the charts show that the buying pattern is here. But over here, you can see there is a selling pattern here. 200 below 50, below 20, below 8. 200 below 50, below 20, below 8. Again and again and again, it's showing a selling pattern. So, and over here also, you can see this higher high and this higher high are almost same. Until now, it's almost same. So somewhere we find from these charts that, hey, this stock is getting hot, time to probably exit. So what is the sales growth? It would not be more, what the profit growth would not be more than 15-20% if I had to make a guess. Let's see. See, 19%, then 8%, then 30%. So last 3 years, it has given only 8% profit growth, right?
Mhm.
So what is the basis for the share price to grow from 300 to some 1,200 4 times? There is no fundamental basis to grow up 4 times. It's not like companies growing at 40%.
Okay, so it is better to exit now.
Considering all these factors, it is a safer sign to exit.
Yeah.
But again, we have to take a call. Maybe they are opening, say, some 20 new centers and they're expecting a 50% growth in their business, or there may be some news. We have to check all those factors. If we find some interesting news and some research, and then we have to interpret that saying, okay, because of these factors, I expect that the stock will go up even further. If we think of that, then maybe we can hold. If we are not sure of it, then if we are at a good profit, be safe and just exit. If we think the company will do badly and the share price will fall, then again it's time to exit. So we have to take into account all those factors. So the things that we have discussed in terms of the price and these things, this is just one part of the equation. It's a very important part of the equation, but it is just one part of the equation. We have to analyze all the holistic things, and then based on all that, we have to take a decision in terms of buy and sell. As far as this chart is indicating that, that it may be better to, sell, that the stock is very highly valued and price is very high and all. But this is one important part of the equation. This is not everything.
Okay.
So we see this, and then we read all the news and other things, not the news. I typically rely on all these notes, transcripts, and then are they doing anything? News again is we look at objective news. They are building 10 new centers, 5 new centers have opened. They have recruited so many more people. They have acquired some other brand, objective news. And then we take a call.
Okay. Okay.
Okay. Thank you.
Thank you.